Alright, welcome to another video. This is Frank Millionaire. Yes, just like in the previous videos, we have been looking at how to understand the market, alright? And now that we understand the market, remember in the previous video we looked at where the market always goes, okay, how to tell where the market is going and where it's going to stop from. So we looked at the pivot points. Now today we're not looking at the auction market theory, we are looking at what we call fine tuning, okay? Now basically I've skipped the 3 stages of institutional trading, and I've skipped actually the middle stage, okay, which is intraday. So we looked at the context in the auction market theory. Those that haven't watched the previous 2 videos, you can actually just look around here in the corner, on the right corner, you'll be able to see those videos, all right? They are linked. You can just go and watch them to understand the market more, all right? So basically, back to fine tuning. So we have skipped the intraday for a reason that I'll give you in the past, because you cannot look at intraday without knowing how to execute your trades, okay? Now that we understand the market always goes up and down, and why it goes up and down, okay? Today we are going to look at where to enter from, okay? Fine tuning is commonly known as execution, or you can call it placing orders, all right? Placing orders, okay? So what will so where do you enter from, okay? In my brackets, there are things that you should consider. There's what we call the static value, and then there is the dynamic value. So we're going to look at the static and dynamic value, basically looking at our charts here, okay? But before we look into those two, I need to differentiate what we're about to learn, okay? Because we are institutional traders, and the strategies that I teach you here have to make you a minimum of 95% accurate, or minimally, if you're a poor performer, at least it should be 90% at least, okay?
Really?
Now, this being said, I need to show you why the things that you've been learning have actually been making you to lose money, because it's retail trading, all right? Retail trading nonsense.
Look at this.
Sorry to say, but this is it. You are told in retail trading, because this is the concept, you are told that 90% of your trading is your psychology, how you think and all that stuff, okay? And then 75% is for technical analysis. Then they have fundamentals that they never know which percentage. But then adding up this month gives you 165%, and we can all argue 165% that never exists, because percentages stop at 100%.
Hey. This is the work of the devil. I cast you and I bind you and I rebuke you in the name of Jesus. Amen.
Okay, so if you're grading anything and you're using percentage rate, that means it has to stop at 100. Okay, so this just shows you that this is exaggerated bullshit. Sorry to say. This is exaggerated. The moment somebody tells you psychology is 90% you're trading, then it's like they're saying when you wake up and then you feel good, okay, or you feel less stressed, but then you feel like you want to come and buy gold or sell it. You understand? That's exactly what they are saying. Because you feel like doing it. You get? And trust me, that's really nonsense. You understand? So technical analysis, yes, retail technical analysis is 75%, and this is why this means that you're left with 25% to make 100. Okay, so basically you have 25% chances of blowing your account, and that's a huge percentage. We can all argue. If they tell you to risk 1% of your account, I'm risking a 1%. Imagine you risking 25% with your strategy.
Hey. This is the work of the devil. I cast you and I bind you and I rebuke you in the name of Jesus. Amen.
It's a lot of gambling, okay? So retail is basically gambling, and this is why what I'm about to tell you is vital. Bano abantu bonna ababasomesa bino, let it be BTMM, mubala institutional levels, oba mubala trend line, oba mubala SMC, smart money concepts, oba mubala whatever method you're trying to use, whether SMC, BTMM, whether trend line, support and resistance. This is the reason why they keep blowing, because this percentage is just exaggerated. It doesn't make sense. And for fundamentals, they never know. Now, I'll tell you one thing. When you're looking at institutional trading, I'm an institutional trader, there's what we call the market context. Okay? The moment you know the market context, you're already 70% accurate. Okay? Literally, we are remaining with 5% to make it to technical analysis. You get? Then, there's what we call intraday. Intraday, I'm very sure those of you that use a broker like mine, who is Exness, okay, in case you need to open up an account with them, the link is down in the description below for Exness. You can just open up an account with them. They give signals, but then they have intraday. So that's it. But you've seen those signals with intraday, okay? Intraday signals, okay? The moment you know intraday means you know where the day is heading, okay? So how to analyze intraday? The moment you finish analyzing intraday, ofuka 20%, where you get 20% accuracy, you increase your accuracy by 20%. So basically just adding intraday and the market context, you're already 90% accurate.
Well done! Clap on for yourself!
Then we come to the final part, which is fine-tuning, which is only 5%. Okay? 5% of your trading. Okay? Fine-tuning, we have just said, this is placing trades. Fine-tuning to what take our trades is a we are actually executing our trades in fine-tuning. So when you add this up, it gives you a total of 95%. Now the question is, where is the other 5% to make up? To make up the 5% to make up the 100%. That is where nonsense like psychology and journaling, we call it supplementary. That's where we find this nonsense. Psychology falls under the 5%, okay? Because the only psychology that you will have while as an institutional trader is either you're going to take the trade or not to take it. There's nothing like psychology. I want you to trading. I want you to understand trading like learning how to ride a bicycle. Understand trading as if you're riding a bicycle. Now, you can never wake up in the morning, I've forgotten how to ride a bicycle. You can never. Okay? It is only, and you cannot say that you failed to ride the bicycle because of your psychology. You get, this is a skill, and if it's a skill, then, well, the skill is called Forex trading, not psychological coaching. Okay? If you have emotions, go to a psychiatrist. You understand? But this skill is called Forex trading. This is how institutions trade. This is how retailers trade. Now, because of this nonsense and these exaggerated percentages, they keep showing you blue screens without evidence. And I'll tell you this. There's no retail trader that is going to show you their trading background. Everybody that is inside the group, our free Telegram group, has seen my trading history. They have. And I will prove it with 3 months. You understand? So basically, if you want to also enter into the group, the link is down in the description below, where you can enter our free Telegram group. That's the Forex Traders Room, UG. You can enter, all right? So basically, this is nonsense, and this is the reason why you've lost all your money, okay? Because you're dealing with a strategy that is only and only 75% accurate. And adding your emotions that they make it 90%, basically 90 minus this, you're left with 15% accuracy. So you're already 15% accurate. Can you imagine such nonsense? But I'm not here to patronize anyone. If they can disprove it, they should disprove it. And I'm going to show you how to analyze these charts, despite the fact that you don't have institutional trading tools like mine here, like the footprints. Okay, like mine here. Now, like I'm looking at BTC, and we can all argue that this thing is still moving. Okay, actually, let me decrease these tickers. Let me decrease them to 0.01 and then apply, and then you can see. You see this thing is moving here. These numbers are changing. I just don't want to. Okay, so basically, these systems are available for everyone that is inside the Millionaire FX. They can witness. You can see the numbers, the volumes here, and you can also see the delta. The delta. If you want to change the chart, you can still change it. And of course, we shall go to more to understand as we dive inside the video. All right, inside the video. So basically, this is the footprints, and here I'm looking at BTC because it's the only currency that is a currency pair that is moving. Actually, it's a crypto pair. Okay, and you can see the entries. Okay, you can see the entries. So basically, I would enter from this ticker, and I also entered from this ticker here, and still I'm in profit. So basically, that's it. And you realize there's no, my MetaTrader is not open. Nothing is open. It's just the software itself relying on itself. So it's not an indicator. It's the software itself. So it's available to everyone that is inside the Millionaire FX. So back to this, how now to know where we enter from. All right, so let's dive in. All right, so as we said, we are going to look at where to enter from inside the market, and we need to consider what we call the static value. Okay, and the dynamic value basically, but let's look at this. Okay, we'll consider the static value first, and then we shall look at the dynamic value. So back here, static value, dynamic value, or dynamic is known as the developing value. So what is the static value? Static value, now if I look at if let's say we look at these candles here, okay, these ones have already formed. They can't form anymore. Like this candle already formed and it was bullish. Never in a lifetime will it ever change. It was formed, okay? Then the developing value is this candle here, okay, that is forming. That is the developing value. So while we are looking for where to enter from, we consider the developing value. Now I know in the previous video I talked about where to know that where the market is heading. Okay, so we know where the market is probably able to change from, and we say those are doji candles. Okay, but let's look at where to enter from. So we're going to backtest. Okay, when you're backtesting, make sure you have one line. Decrease these things to one line. And also another thing is that if your mentor does not backtest like this, mentor won't start backtesting abwati duka kitegeera kuba akolemba nti egenda kukkira naye nga yagirabye edda. So this is good and backtesting one. Okay, nja kufuna bar replay wano and I'll just randomly select. Okay, so I remember having told you timelines is backtesting best timelines to enter, especially ng'okyalaba retail charts z'obwoti toyina institutional software. Okay, bambi bw'oba okyalaba charts z'obwoti, make sure that if you're still seeing bar sticks or candlesticks, okay, make sure that you always use the daily time frame. Okay, and I'll tell you why. As I've said, there are there are 3 stages to institutional trading. One is the market context, to know where the market is heading. Now, like here, we can all see this market is going down. Okay. Then 2 is to know the intraday. Where is the next day? Now, this is the day that was last. So this next day, where is it going? Okay. Where is this day going to go? Okay. Then we need to also know where we should enter from, fine tuning. Okay. So we said analyze daily time frame. Okay, so basically when you're analyzing the daily time frame, you're doing what we call intraday. Okay, so I'll do this. I remember having told you, look for the highest wick to the body of that candle. Okay, now that wick represents rejection. Wick edaga nti waliwo amaanyi agaasindise gaganye basukke your price. kyova olaba gagisindise bwe bagisindise nekka. Okay, then also look for the lowest wick. Kati nga wano kuba we want to see where the next day is going. So basically olunaku oluwedde lubadde wano yeno lowest week wano gikwate dda wano week to the body. Okay, bwetyo. So bwe tutunuulira liquidity nti kana katale bwe kaba kakwambuka kagobawa ekitegeera bwe kaba kakwambuka nnyo kajja kugoba wano this level here eno ekitegeera kuba tulina okumanya akatale we kayinza okutuuka kalyoke kakyuke kaddeyo ekitegeera. Naye jjukira nagambye nti rejection zonna zimarking kuba kati ne wano olaba eno kando teyalina rejection waggulu ekitegeera kati twali tukkirira teyalina rejection waggulu so kati rejection yayo yiiyaawe endala. Remember, this is a daily time frame. Okay, so basically on the daily time frame, this just a minute, let me zoom in so that we can draw these things more accurately. So remember, on a daily time frame, it means it will take a day to make this move. Okay, to make this move and stuff like that. So after marking your daily ng'omaze okulaba kuba kana akatale kali mu kukka but of recent bakoze rejection wano naye olw'okuba nti tuli mu down trend, always follow the context. Okitegeera kati bw'oba following a trend, if you're following the trend, because context is as easy as to understand as knowing that context represents the trend. Okay, of course in institutional trading we'll use tools like VWAPs and stuff like that. I'll be showing you that in further videos, but for now I won't. So basically this is just a rejection. Okay, this is a rejection. This week represents rejection. And by the way, for those that are like this is not what you're used to seeing, I'll just show you this when we go to a smaller time from like M15. You realize that there are a lot of candles in here and add what you want, but even an SMC guy would see that this is an order block in here. Okay, this is an order block in here. So basically what you're saying that this is a wrong order block or anything like that, you just don't know what you're doing. So institutionally, let's look at these things. Okay, so come to H4, look at H4, make an analysis, because if I look at H4, I'm actually looking at this entry as a nice one. I'll do this. Now I want to use experience, so I'm going to be looking here. So definitely they made rejection here. Okay, so but if they're going up on 4 hour, it seems like they're chasing this liquidity right here, this one. But of course the biggest rejection is up here. I'll draw this, just a moment. I'll draw this here to the bottom of that candle, that wick. And I'll give this like color blue, okay, so that we can know what is on H4. All right, so basically you can see the other H4 entry that I'll be seeing, because it seems like they're looking for this liquidity here. Just a minute. It's like they're looking for this liquidity right here. All right, so I'm a zoom in. Okay, we said how to see liquidity. Liquidity is always at the dojis, and liquidity is always taken. Liquidity is always taken. I want you to understand liquidity. Now I'm taking the liquidity. Understand liquidity as money in the market. What it was sent in nyingi. So, all understand it as fuel, game mafuta. So basically, the market has to take that fuel and then go back wherever it wants to go. Okay. So since we are in a downtrend, the moment they take this liquidity here on this doji, it has a small rejection. Okay, but you can see somebody will draw this as another block for selling. Okay, but they will draw the full candle. And the reason why I don't recommend drawing the full candle and I recommend drawing the rejection is because if you draw the full candle like this one now, okay, because I'm very sure this would be an order block to someone. Now, if you're drawing this as an order block, let's just say you're drawing this as an order block, okay? Do you agree with me that you're risking a lot? Check. From here to here is on gold is 113 pips on gold. 113 pips. Check this. 113 pips stop loss. This is huge. It's why I call this retail, most people that do this kind of retail, I say they are doing nonsense, because that's a huge stop loss. As versus, because even while marking the rejection, check this. This is a 29 pip stop loss. This is almost, it's 31 pip stop loss. Okay, 31 pip stop loss. Now imagine somebody has 100. Even 31 pips is too much already for somebody that is beginning. So this could be a bad thing for anyone that is trying to, trade. You would have a big loss, like a big drawdown. Okay, this is why you need to actually look to the professionals. And this video is going to be a little slightly longer, but we need to get out from here when we know where exactly or how exactly we should be analyzing. All right. So as I was saying, now we have to make our entry here. So to me, I'll wait for this market. I'll be shorting it because it's a downtrend. I'll wait for it here to make an entry. Okay, I'll make an entry, but remember this is liquidity on this doji. So basically my entry would be there, and I just love putting the stop loss a little bit higher, because then it gives me more confluence. And if we are going down, if it reaches this liquidity after taking it, where do I look for it to go? I'll look for the liquidity that is down this side. So the other liquidity I'm seeing is down here. This is the doji. Okay, so basically I'll be looking at it reaching this level. I love doing short deals, so this will be it. This is what I'll be seeing. Okay, now we can backtest this theory. We have a 91 pip stop loss, but because we are doing it on a huge time frame, okay, and the take profit, we have around 500 pips in take profit, so it makes logical sense to risk 90 pips for 500. It makes logical sense. We can all argue that. So if I play the next day, okay, they're up to get the liquidity, then they get it, then we go. You see that? All right, we are back testing this. Okay, so they're coming back now. You can see, remember what we called the static value. We entered on the candle that already formed. Okay, but then we also need to look at the developing value. They formed new liquidity on this doji, so the market is chasing it again, and the reason why it went back, there was liquidity. Okay, when I point there, it kind of buffers. Just a moment. Come on, bar replay. All right, good. So when there is liquidity, you can see the doji where exactly the market is right now. There's a doji. They just took that liquidity, so they're chasing liquidity down here. Let's see. All right, liquidity always is taken, and we're back testing this live. The moment somebody tells you a theory, at least prove it. Okay, so as we said, developing value is crucial. The only thing that kills people is that they always look at what we call the static value. Mutunulira candles are forming that you look at the candles that are already formed and you ignore the candle that is forming. Okay, obviously this would be, like somebody would take partials on this doji, and there is a doji here, right here. Still somebody would have taken partials, because then they are taking now this liquidity. So if you can't stand the pain, you can, so after taking the liquidity, you can see they took the liquidity, and then they also came for this one. But let's see. Okay, so according to the developing value, still these guys here, they haven't. Let's see what they do. They touch again our entry. Let's see. Oh, now stop loss hit. Let's see. Yeah, they formed liquidity here. So basically you can see that this is on 4 hour. All right, so if we converted everything to days, you will have held this trade. Let's see, just a moment. You will have held this trade because now that this was a consolidation. Remember the auction market theory? This was a consolidation. You realize consolidation, big moves. But let's do this. Okay. Remember, every day, those inside the group know that every day we analyze the market. So basically, if we had analyzed, as we analyzed, because we entered from here, okay, this was the next day. You realize we did the analysis while we were here. You can see this order block where it starts from, okay. So we made an analysis. So our entry was triggered the previous day, okay, and the next day we were in deep profits, okay. Then of course you would see this if you are using the daily time frame, okay, because now I want you to check this out. This here is the huge rejection, the order block that we drew, okay. But we said if the market is still continuing down, this will be the final take profit, the final, okay. But they formed the consolidation here. I want you to understand these things, and whoever is saying otherwise, they should prove, because minimum take profit would be here. This would be take profit 1. Here, let me mark this. This would be take profit 1 because it's the order block where it starts from, okay. But then we are looking at it coming down this side, and then it will hit that, okay. So if they are looking back up, we are looking at it coming back that side, up here. And let's prove now we are playing on a daily. This thing is not moving. What happened? Okay, so they were just blowing out this SMC, and then they came back and touched again. We are playing now through daily. We are playing through daily time frame. But as of course, as I said, where we entered from, that would be it. This take profit will hit, and trust me, you can see this. It will hit, and this is not crammed because we just selected random. You get? So they blow. This is why, by the way, SMC, if you're using SMC, because this is perfect SMC, just refined, all right? This is SMC. You will see that it will give you, this is the percentage, it's around maximally 80%. So it will give you, okay, from a higher time frame, that is H4 entry, we entered from here, and then we can all argue that at least by the end of the day, of which I'm very sure anybody that is using this, they rarely hold trades for all these days, because these were 300 pips in profit, 300 before they even came back, okay. And if you're analyzing every day, because the moment this take profit, this order block is hit, you take partials, okay, and hold the rest, and then have like a stop loss that is at break even, okay. But you realize 300 in profits, and even when they came to blow, I want you guys to see this logic. Even when they came to blow, our stop loss from here to where they blew, we lost 90, but we had already made the 300, okay. And check this out. Okay, now I'm having these things getting into the way. All right, and check this. After they had blown this, because this would be clear, this was another rejection here, okay. You would enter still and then take profit here, okay. And this is daily. We can all argue that they are back. They are trying to come and hit this. Like it or not, they will hit it. They will hit it. Like it or not. They're just back testing. They're back to the entries. Do this. Now this is the accuracy of SMC, and this is why I want to transform everyone from, retail to institutional, okay. But still, with this retail I'm teaching, you realize that the next day, because this here is liquidity here, okay. This is liquidity, and this is another order block that was formed here, okay, if you're looking at a daily. But also, just to beat the logic, it's one after we entered 1 2 3 4 days, 1 2 3 4 5. Actually, it's the week. The week ended with us in profit. Like, come on, we were still in profit. Then it's the next week that the stop loss was hit. So if we're doing the daily bias like every day, you realize still that you will still realize that even if let me see, yeah, you still realize that even if you were stopped out, you made more pips than the stop out. So even if you took partials from here, still this would make sense. And the reason why, by the way, we still held on, or we are still holding this trade and saying this entry is still valid, even after it's mitigated, because the moment they kill this, the order block becomes this one, because this was killed, okay? It was a mitigated order block. But after they had given us this, you understand the logic, okay? So this would be the other entry, okay? But even with SMC, because this is a consolidation big move, remember the other big move, the other liquidity is up here, okay? So if we are to play this, we are playing it on a daily so that we do not take long here, okay? So they tap into that liquidity and then they come back down. You see that? And this is taking days. You see that? It's taking days, and then still here they are. They have so you can see that take profit is finally hit. They have taken that liquidity and then they will go back up. You understand? So basically you realize that if you're making H4 entries, okay, daily bias, then look for H4 entries, okay, H4 entries. Realize that in, let's say, actually let me leave on days so that we can calculate these things very properly. All right, let me leave on daily so that we can calculate these things properly. So in a period of every five candles is a week, right? So in a period of let me do this. If you're just making those entries, and remember here you're based on static value. Just a moment. All right, remember here you're based on static value, okay, the candles that already formed and then the developing value, okay? So you could see liquidity here was formed, okay? I don't like scalping because I'm a swing trader. I don't like scalping. It gives you that high blood pressure. But then this is it. You realize that this take profit was tempted to hit, but yeah, because there was liquidity, there was a doji here. I remember telling you liquidity is always taken at the start of the video, and it's only the retailers that do not want to allow this. But in a period of we were stopped out 91 pips, but we got 300 already, okay? And still I want you to check this out, and I'll teach you this when we start institutional trading. The same entry here was, you see this? It's the same entry. I'll actually just do this. Copy and then paste. You can't. Okay, let me do this. Same entry, okay, with the same take profit, okay, and the same, the same risk, okay. Actually, this risk was even smaller. Check this. It hit. Same trade. Check this. Same trade. And I'll give you a reason why it is the same trade, because the same volume. Here, those that know how to use the volume profile inside Millionaire FX, you know how this works. You get? Because these imbalances are already discovered. This. So same trade. So literally, the same trade would give you 300, okay, and then they will take you like 90 out, and then it will give you 600 pips. Oh my god, check this out guys, 647 pips in a profit. 600 in a profit, in profit. This is why I tell people that always backtest, because even here, remember, the other entry would be here because we had already seen this on a static value. This. Check this. And the risk here, check. And remember, we are playing, this is a daily time frame. Check this. Check this out. We had risked 169 pips in a reverse for 1086 pips. It makes perfect sense. This is why I tell you, when somebody is teaching you a formula, just know, and this is the retail formula, all right, SMC, okay? It's the most accurate, by the way, of all retail strategies. This is the most accurate. Okay, but you just have to understand the market, just like I told you. So where do you enter from? The rejections on a bigger time frame, on a daily time frame. This rejection here. Otherwise, SMC would have marked this entire order block, and you see how big that risk was. This is more like what you guys call the sniper entries. You just tapped and then boom. You understand? So for you to get even this one while we are entering it the first time, check this out. Check this out. Check this out. Imagine. Even this, while we are entering this one that the stop loss was hit. This. It's more like a sniper entry. Ta. Then it came. Ta. It came. They're like sniper entries. So backtest using this. I know I charge a lot of money for mentorship. I charge $200 for now, but then next month it's going to be $300. But right now it's just $200, and it comes with a funded account, of course, a funded account of 5K. And if you don't believe me, you ask the people. There's a free Telegram group, by the way. You ask people in there. The link is down in the description below, and you will notice that we are very honest. We are very honest, and we have results. So the percentage, you can see that out of a percentage of 1, okay, 2, because these were already formed. If you started the video, we had already drawn this 1, 2, and then 3. Okay, so you lost once, and then okay, because this entry here wasn't triggered. It wasn't, was it? It wasn't. So the moment you're using retail strategies, please use the higher time frame. Okay, unless you have softwares like the footprints. Okay, like the footprints. Okay, this is gold now. I can see I can see it, and I can even actually download data. Let's say today is let me see the date. Today is 28th. Okay, so I can download let's start from this, and then I can download this data, and then we can see how the entire week moved. So it's downloading the data from Monday till today. So basically you can use this software to look through. Okay, and of course you can see the delta down here. It's showing it's a nice downtrend, a nice one. And of course entries are always given to you, and you can use this for scalping, because you here you're based on numbers, real data, the number of orders that are inside, and then you also have the volume profile this side. I'll be teaching this in the future, but for now, for all those that want to get this software, of course, the software, you have to just pay, mentorship, so we can see through the data. Actually, if I do this daily, I want to get the daily candles. All right. So these are just 5 days downloaded. 1, 2, 3, 4, 5. They're just days, and I can make the tickers like 5. Oh, they're already 5. Just a minute. I'll make them like this. So from Monday, I just wanted to see this from Monday. This is gold, and if we came here still, and we are looking, you can see it's the same structure. We are back testing here. Sorry for that. So consider always consider the static value for entries, and then the static value, we say those are the previous the previous candles that were created. They can never change. You can see liquidity from there. Then where to move out from, okay, this is where you should be making your entries. Then where to move out from should be the developing value. Are you seeing a doji being formed? Basically they are forming liquidity to push the opposite side. You can see that. Okay, even here they pushed down. That's the easiest way. Always where the dojis are, that's liquidity. Okay, and the liquidity, if the liquidity has just formed, just know they're going to make a big move. So that's it. I hope you like this video and subscribe. Also comment down just to make me able to answer your questions. So I hope we have covered where to enter from and where to move out from in this video. I hope to see you again in the next video. subscribe and like this video, and also go to the free Telegram group. The link is down in the description below. All right, other than that, enjoy the rest of your weekend back testing.